Graham Bibby, Chief Investment Officer, and today I'm joined by Matthew Leong, Portfolio Manager, and we're here to give you a year-end update and a bit of a view into next year. It's been quite a dramatic year this year, and for the economic scenarios, I'll paint the picture of what we've seen and what we think is coming forward in the new year. We've seen quite a resilient market this year, and also the economy. The underlying economies, we thought there would be a recession this year. Many had that priced into their assumptions and their forecasts, but it hasn't happened. So why hasn't that happened? Probably because there's been more money out there in terms of savings and more resilience in the both consumers and corporates out there. And there's also been a lot of government spending that's flowed through to the economy, more so than other cycles before. So we see differences between the international economy, particularly the US and Australia. So the US is a little bit different because it's had relatively low savings up until the pandemic, and then a lot of savings have been accumulated, and those haven't yet been spent. They've also had a lot of debt that had been built up in the GFC, but they've actually reduced a lot of that gearing. So there's actually a lot of capacity for consumers to gear up again if they want to and spend more. Companies have also had a more resilient position as well through having gotten financing for long-term fixed income issues, and really pricing for that has gone up, and they're not having to refinance yet. So the capacity of businesses has also been pretty good. In Australia, we know that mortgage rates are mostly floating rates, so a lot of those rate hikes have been passed on, and we've still got a lag of a lot of those fixed rate mortgages still running off. So the benefit that Australia has, though, versus other markets, is that we are a relatively high income nation, even though we've got high debt loads, and relatively we've got this high housing debt that has caused concerns, but really we've had a lot of beneficiaries out of higher interest rates, those retirees and later career people who don't have the net debt, but younger and less the fortunate people with their income or family situation. So we see that out of that process, looking forward to next year, there's a whole range of scenarios that could play out. We see that recession, it could be a deep recession, is quite possible, but a lower probability now. There's a lot more resilience. So we think the scenario in the middle, which is really our base case, is a soft landing or some degree of downturn that's noticed, but isn't going to be broadly felt. The other scenario is that there's just no landing at all, and that we come through this experience and no one really notices a downturn. So that's more than no landing. We think all of those scenarios can be priced in at various times, and there's a lot of seasonality in that. So Matt, how would you see that's been priced into markets through this year, really now, and what could happen into next year?
Yeah, sure. So just a bit of a review of what's happened in markets this year to begin with. Equity markets have been really strong. I think at the start of the year, people were anticipating a bit of a downturn, which didn't eventuate, and people were conservatively positioned ahead of that. As a result of the resilience of the economy, we've actually seen equity markets in the US, for example, up nearly 20% in US dollars as at this date that we're recording this webinar. And in terms of Australia, not doing quite as well, but still up around 7%. So that equity market has been doing pretty well. Fixed income hasn't done quite as well, just because some people were expecting cuts this year, which again, due to the resilience of the global economy, that hasn't quite eventuated as yet in most major economies. So fixed incomes bouncing around flat to low single-digit returns up to near the end of 2023. In terms of how we're positioning and how we see the outlook for next year, we're still a little bit conservative. There is, as Graham said, a wide range of outcomes. So our equity positioning right now is actually close to neutral. We did add back to equity during the sell-off in October for our model portfolios, so that's worked out quite well. And we are broadly neutral across both Australian equity and international equity. We do think that international equity will not necessarily see the same tailwinds as historically with the US dollar strength, given that the US dollar has been quite strong for this year. What about fixed income markets, Graham?
I think the fixed income markets have priced in a lot leading into the year end. So we've seen potential rate hikes being priced in more. So we saw a peak in the long bond rates, 10-year bonds in Australia and the US, just over 5%. They've come back now as it seems that inflation's continued to come down, and the central banks have messaged that they're unlikely to hike anymore. It seems like they've achieved the mission accomplished with some caution, and they're unlikely to hike more from here. They might still do one or two, you never know. But we think there's more downside and that in yields, and there's potential to cut next year. But that would actually require the economy to have some sort of degree of heat come out of it, and that downturn to happen before rates would be cut. So we think overall there's still some downside for fixed income.
And we've seen thematics play a lot into returns this year. What are we thinking for forward-looking thematics?
Well, I think some of the themes that we've seen this year will continue to play forward. So things like AI, there's been an incredible boom in the number of stocks that are connected to AI, and some of the very, very large names that are, have linkages there, from NVIDIA to Microsoft and Google. But beyond that, there's a lot of other opportunities. So things that combine technologies. So we think there's a convergence of technology, AI, big data, even to blockchain and other things that then get augmented into combined productivity improving activities. And we will really need these as populations are declining in some countries now, including China and Japan. And so they need automation, they need technology improvement. Other things that we know are going to be very long-term factors here, and we'll just recap on some of them. Energy transition from the generation, transmission, the transport, EVs, to the materials needed like copper. So there's a lot of opportunities right across the board. Geopolitics plays into the assessment now. It's now an integrated assessment that you need to make. In the manufacturing supply chains, there'll be things that you need to look at across where things are being onshored. So a lot more manufacturing that will be required onshore and to friendly neighbours. And social change, lastly, will have an effect on institutions and the role of democracy and communication. So the advent of social media and the polarisation of opinions. All of those have to be considered in long-term themes, and some of those will be priced in and out. There'll be some great opportunities for the year and years ahead. I think that's a good wrap-up for the year and a bit of an outlook into the year ahead, and have a safe holiday period. Thank you.